All right, let's jump right in. We're going to get inside the head of Warren Buffett using his own words to really unpack the principles that built Berkshire Hathaway. And look, this goes way beyond just picking stocks. It's really a masterclass in thinking about business, about value, and ultimately about what success actually looks like.
And of course, Buffett kicks it all off with this absolute classic. I mean, what a great quote. It's his brilliant kind of folksy way of saying, hey, just because it's raining doesn't mean you're the one making the pond rise. It's a fantastic warning against letting your ego get the best of you. And honestly, it sets the perfect tone for everything we're about to cover.
So here's the game plan for this breakdown. We'll kick things off with that right-thinking duck. Then we'll get into what truly counts, the art of waiting for the fat pitch, the power of float, why you should cheer for lower prices, and wrap it all up with what he calls the Berkshire way.
All right, first up, the right-thinking duck. This whole idea is about being brutally honest with yourself. I mean, how do you really know if you're any good or if you're just getting carried along by a bull market? Well, for Buffett, it all starts with picking the right measuring stick.
And this example just says it all, doesn't it? In 1997, Berkshire's book value shot up by over 34%. That sounds amazing. But Buffett himself, he called it a quack. A quack! Why on earth would he do that? Well, because the S&P 500 grew almost as fast. See, a right-thinking duck doesn't care that the pond level rose. It cares about where it stands relative to the other ducks. Since they barely beat the market, in his mind, it was nothing to brag about. Okay, so that leads perfectly into our next point. Because if beating an index is the benchmark, what are we actually measuring? Buffett makes it super clear that accounting numbers, things like book value, they're just not the whole picture. He wants us to dig deeper, to focus on what truly counts.
So you've got these two ideas side by side. You have book value, which is, it's an accounting number. And don't get me wrong, seeing it go from $19 a share to over $25,000 is, wow, that's impressive. But Buffett is always telling people the real number to watch is intrinsic value. That's the true underlying worth of the business. And in his words, it far exceeds book value.
And this right here is the heart of it all, intrinsic value. It's not some neat little number you can find on a financial statement. It's more of an estimate. Think of it as all the cash a business can spit out over the rest of its life. If you can wrap your head around this single concept, you're basically unlocking the code to how Buffett thinks about everything.
Which brings us to our next big idea. And honestly, this might be the toughest one for most of us to actually do. It's all about the discipline of patience, of sitting there and doing absolutely nothing until that one perfect moment arrives. And Buffett uses this incredible analogy to explain it. He talks about the baseball legend Ted Williams. Williams literally mapped out the strike zone into 77 little boxes. He knew if he only swung at pitches in his absolute best spot, he could bat .400. But if he started reaching for bad pitches, his average would drop all the way down to .230. It's such a perfect metaphor. So how do you apply that? Well, it's pretty simple, really. Step 1, figure out your best sell, what Buffett calls your circle of confidence. Step 2, just wait. You wait patiently for that perfect, fat pitch to come right into your zone. And step 3, this is the real game changer. Unlike baseball, in investing, there are no called strikes. You can literally stand there forever and never swing, and nobody's going to call you out. You just wait for the one you can't miss. So you might be asking, how can anyone afford to be that patient? Well, a huge piece of the puzzle is Berkshire's secret weapon, the financial engine that powers the whole operation. And that engine is something called insurance float. Let me break down what float is. It's actually pretty simple. When you pay your car insurance premium, the insurance company gets your money today, right? But they might not have to pay out a claim for you for months or even years. All that money they're holding in the meantime, money that isn't technically theirs but they get to use, that's float. For Berkshire, it's like a gigantic interest-free loan that they can invest for their own profit.
And the scale of this is just staggering. I mean, look at these numbers. It grew from about $20 million in the 60s to over $25 billion by the end of the 90s. But here's the truly mind-blowing part. Because their insurance businesses are so disciplined, this float hasn't just been free money. They've often generated an underwriting profit. So they are literally getting paid to hold on to billions and billions of other people's money. It's an almost unfair advantage.
All right, next up, we have a lesson that really goes against every instinct we have as humans. It's all about how you should feel and what you should do when the market is in a full-blown panic and prices are just tanking.
So let me ask you a little quiz, straight from Buffett himself. Imagine you're going to eat hamburgers for the rest of your life and you're not a cattle rancher. Should you be hoping for higher beef prices or lower beef prices? I mean, it's kind of obvious when you put it that way, isn't it?
Yeah, of course you want lower prices. You want your hamburger to be cheaper. And Buffett's whole point is that investing should be exactly the same. If you're going to be buying stocks for the next 10, 20, 30 years, you should be doing a happy dance when the market crashes. It just means your favorite companies are on sale. You should literally be cheering for sinking prices.
And that brings us to the final and maybe the most important piece of the puzzle. We've talked about numbers, we've talked about strategy, but for Buffett, the ultimate sustainable advantage comes down to just one thing: the people you're in business with.
And there's no better story to illustrate this than the one about R.C. Willey, a furniture store Berkshire bought. It was run by a guy named Bill Child. Now, Bill is a Mormon, and one of his core principles was that his stores would never open on a Sunday. You can imagine, in the world of retail, that's a pretty big handicap.
So when the company wanted to expand into Boise, Idaho, even Buffett was pretty skeptical that this no Sunday rule would fly outside of Utah. So what did Bill Child do? He made an absolutely incredible offer. He basically told Buffett, look, I will personally fund the $9 million store. If it's a success, Berkshire can buy it from me for what I paid. If it's a flop, the entire loss is on me. He put his own money on the line to protect Berkshire.
Well, guess what? The Boise store was a runaway success, a huge success. So Bill sold it back to Berkshire at his exact cost. But here's the part that gives you goosebumps. He refused to take a single penny of interest for the $9 million of his own capital that was tied up for 2 whole years. Think about that. It wasn't about making a profit for him. It was about his integrity. It was about proving that his principles worked. And that story right there is the essence of the Berkshire way. It's why Buffett says he gets to tap dance to work every morning. Because for him, the real joy, the ultimate competitive edge, is partnering with people like Bill Child. People who are not only brilliant at what they do, but who operate with absolute, unshakable integrity.
So, I guess I'll just leave you with this one thought. We've talked about all these smart ideas: intrinsic value, waiting for the fat pitch, the magic of float. But the final lesson is so much simpler. It's about people. So the next time you're evaluating a business or maybe any big decision in your life, are you just looking at the spreadsheet? Or are you looking deeper? Are you looking for your own Bill Child?